If I could sit across from you right now, I wouldn't start by talking about stocks or charts or the latest market news. I'd start with something much simpler, because investing isn't about being smart. It's about being rational. And over the years, I've learned that the biggest enemy of investors isn't the market. It's themselves. The core philosophy, you see, my approach to investing has always been very simple. I don't try to predict the market. I don't try to time the market. I try to own great businesses. That's it. Think of it this way. If you were going to buy a farm or a small business in your town, would you buy it because the price might go up next week? Of course not. You'd look at how much money it makes, how stable it is, and whether it will still be around in 10, 20, or 30 years. And that's exactly how I look at stocks. Stock is not a ticker symbol. It's a piece of a real business. Circle of competence. Now, one of the most important ideas I've followed my entire life is something I call the circle of competence. It simply means this. You don't have to understand everything to succeed. You just have to understand a few things very well. There are thousands of companies out there, but I only invest in the ones I truly understand. If I can't explain how a business makes money in a few minutes, I pass. No matter how exciting it looks. Because in investing, what you don't know can hurt you far more than what you do know. Economic moats. Now let's talk about something I love. Economic moats. Imagine a castle. The stronger the moat around it, the harder it is for competitors to attack. Businesses are the same. I look for companies with strong competitive advantages. It could be a powerful brand, low costs, network effects, or something that makes it very difficult for others to compete. Because when a company has a strong moat, it can protect its profits for a long time. And time is the friend of a great business. Margin of safety. Now, even if you find a great business, you still need to buy it at the right price. This is where the idea of margin of safety comes in. I don't want to pay full price. I want a discount, because the future is always uncertain. Things can go wrong, so I build in a cushion. If I think a business is worth $100, I'd rather buy it at $70 or $60. That way, even if I'm slightly wrong, I'm still protected. It's not about being perfect. It's about avoiding big mistakes. Long-term thinking. Here's something that might surprise you. My favorite holding period is forever. Now, that doesn't mean I never sell, but it does mean this. I invest with the mindset that I'm going to own a business for a very long time, because the real magic in investing is compounding. Money grows on top of money year after year, decade after decade. But that only works if you stay invested. If you keep jumping in and out, you interrupt the compounding, and that's where most people lose. Ignore the noise. Every day, the market is shouting at you. Prices going up, prices going down, breaking news, predictions, fear, excitement. But here's the truth. The market is there to serve you, not to guide you. Think of it like a partner who shows up every day offering to buy or sell at a different price. Sometimes the price makes sense, sometimes it doesn't. Your job is simply to take advantage of it when it's in your favor and ignore it the rest of the time. Temperament over intelligence. People often think investing is about having a high IQ. It's not. You don't need to be a genius. What you need is the right temperament. Can you stay calm when others are panicking? Can you be patient when nothing is happening? Can you avoid getting greedy when prices are rising fast? Because the market has a way of testing your emotions, and those who control their emotions win. Be fearful when others are greedy. You've probably heard this before. Be fearful when others are greedy, and greedy when others are fearful. But let me explain what that really means. When everyone is excited, prices usually get pushed too high. That's when risk increases. And when everyone is afraid, prices often fall below true value. That's when opportunity appears. The problem is, doing the opposite of the crowd is uncomfortable. But in investing, comfort rarely leads to success. Over the years, I've seen incredibly smart people fail in investing not because they lacked intelligence, but because they made things too complicated. They chased complex strategies, fancy models, short-term predictions, but the truth, simple works. Buy good businesses at fair prices, hold them for a long time. That's it. If I could leave you with a few simple principles, it would be these. Don't invest in what you don't understand. Focus on businesses, not stock prices. Demand a margin of safety. Think long-term. And most importantly, stay rational. Because investing isn't about beating others. It's about controlling yourself. The stock market will always be unpredictable. There will always be fear. There will always be noise. But if you stick to sound principles and keep your emotions in check, you don't need to be extraordinary. You just need to be consistent. And over time, that's more than enough.